I'm the CEO of a company called Early Growth Financial Services, and the way I always describe us is that we do is very not sexy, but we do it in a very sexy space. And the not sexy thing that we do is we're an outsourced finance and accounting organization. So in the same way that Google or Microsoft or Amazon has a CFO and a finance and accounting department, we do the exact same thing for our clients, but on an outsourced basis. So we do taxes, we do valuations, but we also, our core business is that we have a large team of CFOs, and we have an even larger team of senior accountants, and controllers. And we do all the day-to-day accounting for our clients, and then we do the higher level strategic things, like fundraising and pricing and forecasting and budgeting. Not very sexy, but the sexy space that we're in is the venture capital space. And we have about 750 venture capital backed companies as clients. Somewhere between 15 to 20% of the VC marketplace. We're located in San Francisco, Silicon Valley, LA, Seattle, Chicago, and New York. We have clients around the country, but those are the places where we have people on the ground. Well, that's the only sort of marketing piece that I'll give. We've had a lot of clients that have obviously become big deals over the years, but we had Uber also, which we should probably put up there. But which is probably at this point in time, it's the most well-known client that we have, although always a little controversial. Other people have questions on sort of who we are? Okay. The presentation that I'm doing today is on accounting and what you need to think about for accounting. And we'll spend a lot of time talking about what you need to do for accounting pre-funding, which it sounds like a lot of you are still in that sort of very early stage. So sort of what do I need to do and not get in trouble? And then we'll talk a little bit about what we do, what you should do for accounting post-funding. And then we'll talk through some things like systems. What type of accounting systems should you be thinking about? What's available out there in the cloud? If there's other questions about things like fundraising or other aspects of creating your financial infrastructure, go ahead and just let me know. Is that cool? Cool. Okay. So if you're a pre-funded company, which it sounds like you guys are all kind of in that stage, I don't think you should hire someone. I don't think you should pay someone to do your accounting for you. But I do think that there's some simple things that you should always be aware of. And the first thing that I always tell people to do, and this sounds really simplistic, is separate your personal assets from your business assets. So have the financial discipline of setting up a bank account for your business. And if you're going to put your own money, if you're going to spend $15,000 or $20,000 of your own money on your business, instead of pulling that money directly from your checking account or your savings account, put it into your entity's bank account so that you're flowing the money through that bank account. It gives you a very clear audit trail, so you have details on everything that you spent for your business. But it also, a lot of early stage founders will commingle their funds. It'll be hard to tell what's a personal expense and what's a business expense. In the same way that I think it's a good idea to have your own bank account for your business are you setting up a business or a nonprofit?
Still working on that.
Still trying to figure that out, but it doesn't matter which, right? So if it's a nonprofit, you just set up a bank account for your nonprofit. If it's a business, you set up a bank account for your business. But the discipline's still there. And I would even say that you should carry that discipline over into your credit cards. So if you can get a corporate credit card or a business credit card from your bank at an early stage that you can run all of your transactions, all of your credit card transactions through, do that. I know that's kind of a pain in the ass. It's hard to get a bank account if you're or a Visa card or a credit card if you're an early stage business. And so in that situation, I would just have a separate Visa card that you use for your business. You don't use it for any of your personal expenses, it's just your business expense. Does that concept make sense? Just no commingling of funds? This is all sort of really simple stuff for pre-funding. The second thing that you always want to do is you want to keep records. The IRS requires that when you do your taxes, you need to have evidence for anything over $75. And evidence is a receipt or an invoice or a purchase order or a contract. I always tell our clients, just save everything. And you don't have to save hard copies. We suggest you use like a Dropbox or a Google Drive. Our firm is still on Google Drive, and we have a couple hundred employees, and we still use Google Drive for everything we use. But there's a lot of different options, but you can do it online. Just keep those records. It makes piecing together things later on very easy. And if you ever get into a situation with the IRS, you always have that background and that evidence. And you can set up, if there's a lot of transactions, set up just an easy filing system that makes sense for you. And in your early days, it could be as simple as just having it by month, or you can do it by vendor. So those are the two things that I see often is time period or vendors, or categories. Does that make sense? The next thing is, there are a bunch of things that you need to be aware of from a timing perspective. Things that you have to do on a recurring basis, and you want to make sure that you don't miss your deadlines. On our site, on the Early Growth Financial Services site, there's a really good calendar of when the different deadlines are, but you want to think about 1099s. Do people understand what 1099s are? Okay. In the US, if you have an employee, and there's someone that you hire and they're working for you, we call that a W-2. It's just an IRS description. And an employee is called a W-2 employee. Most startups don't hire people, but they use contractors. So they're paying someone else to do some work for them. That's called a 1099, a 1099 employee. And you need to have, so the 1099, you have to send the IRS a piece of paper that has each person that you paid a 1099 to, who that person is, either their tax ID number or their social security number. You know, we all have social security numbers. So you either need a tax ID number or a social security number, and how much you paid them for the calendar year. So for 2015, that deadline is January 31st, so it's coming up. And there is a penalty if you don't pay it. Does that make sense?
Yeah, but is there a minimum amount that you pay to that person so that you declare it with a 1099?
Yeah, there is a minimum amount. I think it's $500, but I'm not sure about that. I'd have to go back and check. But there is a minimum, but it's good whenever you have a contractor, just set them up on a 1099 right from the very beginning, right? Just so you have all that information, because even if you're only planning on spending a little bit with them, yeah. There is an issue with 1099s versus W-2 employees. So the government has said that there's 7 different categories that you can use to determine if someone is a 1099 or an employee. And those categories or those guidelines are things like, do you control the time of the 1099 person? Do they work from your office? Do they use your equipment? So for example, do you give them a computer? Do you control their deliverables and when things are due and complete? There's a series of different rules, but the state of California, in order to get tax income, has really, really cracked down on 1099 employees, and we have never had a situation where one of our clients has been audited for 1099s and where the audit came back and said that they really were 1099 contractors. So it's something that you need to be very careful about. All entrepreneurs that I know use 1099s for their first couple of years.
Well, you said that all the audits you've gotten, they were actual employees?
The state of California has said that they're employees. So when looking at the situation, When our client said, no, these are 1099s. and
Every
here's-
single one.
Every single one. We've never won one.
Wow.
We've never won one. So it's something you need to be careful about. So what I always suggest is understand that you have 1099s and that you're using contractors. As quickly as you can, as you get funding, as you start to generate revenue, you want to turn those 1099 folks over into employees as quickly as possible. Keep record, be careful of mindful of the tax obligations, separate business and personal. Those are some of the big things that I think you need to worry about. So don't commingle funds, set up your own bank account, get a credit card for the business, make sure you understand the guidelines. Oh, so in terms of tax reporting and things of that nature, so 1099s is one. Your California state business registration is a second. If you are a Delaware C Corp or a Delaware LLC or a California LLC, there's also an annual registration for that. And then there's state and federal taxes. So understand what all those guidelines are. There is a nice thing about taxes, and it's a weird statement to say that there's a nice thing about taxes. But for taxes, if you started your business in 2015, you have your tax deadline is March 15th. So coming up soon. However, you can file an extension. And the extension is just a half-page document, very easy to file. And that extension will give you until September 15th. So if you started business last year, get your extension filed so you don't have to pay a penalty, but then you have until September to actually finish up your taxes. Then going forward after that, you have to make tax payments on a quarterly basis. Or in the case of all of you, you probably aren't going to be making a lot of tax payments your first couple of years, but you want to make sure that you still do a good job with your taxes, because in the United States, you can carry forward your losses from previous years into future years. So you want to make sure that as you're losing money, you raise your hand and tell the government, hey, I lost $200,000 here, so that in the future when you make money, it's a different situation. Other questions about sort of what you should be thinking about in the early days?
Yeah, I have a question regarding having the business account separately.
Mhm.
Can you just put personal money in the business account without any invoice?
Sure, yes, absolutely, absolutely. It's, when you put personal money in, I would make sure that you document that in some way, right? So that if you're writing a check or if you're making a contribution, because there's a couple different ways that you can treat that. You can treat that as a loan to the business that you can get repaid at a later date, or you can just treat it as equity. You know, you're investing in the company. But you can absolutely, and almost all entrepreneurs at some point have to bootstrap, and they're using some of their own money. But if you know you're going to spend $15,000 of your own money over the next 4 months, have the discipline to put it through the bank account before you pull out and use it on vendors and contractors and folks like that.
So, but at some point you have to take it back. Once the company has revenue and stuff, you just take the money that you put.
If you treat it as debt, you can take it back. If you treat it as equity, it just stays in the company. So, it just stays in the company. Other questions? Is that clear? Okay. Thank you. Thank you.
Thanks so much. Yeah, I couldn't answer that reason.
No. Thank you very much. Once you raise money, once you go out and you raise money, you raise an equity round of funding, you borrow some money, or you start to have significant revenue, you should think about bringing on someone that's going to do your accounting for you. I'm a big believer that entrepreneurs should focus their energies on building their products, developing their services, building partnerships, finding customers, and not doing their own accounting. And I'm also a big believer in setting up a really good, strong accounting infrastructure right from the very beginning, because most of the companies we deal with are venture capital backed companies. So in the world that we live in, investors want to make sure that there's good financial infrastructure and controls in place. And as the companies progress, it becomes more and more important that their accounting is really good and very strong. And it often takes more time and costs more money to go back and fix stuff than it does to get it right from the very beginning. So there's obviously there's us out there, but there's a lot of firms that look and feel similar to us that are smaller firms that are in the Bay Area and San Francisco and down in the Valley. I think you can make a lot of really good choices with this, but I do think that you want to bring in professional help and someone that really understands. In the US, it's called Generally Accepted Accounting Principles. It's called GAAP. And those are sort of the big accounting rules that govern how we report on taxes and how we prepare financial statements and what that information should look like. Generally Accepted Accounting Principles. But you want to have someone, either hire someone that's going to come in part-time or hire an outside firm that will help you with those different components. Once you get funding, and once you have some significant revenue going on. We have a program for our clients that have raised less than $250,000, and it's $400 a month, and we take care of the accounting for all of our companies that have raised less than $250,000 for $400. And there's Indian Arrows out there at sort of a low price point, Benches out there at sort of a low price point as well. Once you get more money in, you want to get more professional assistance. Does that make sense? So this is kind of, I think if you've raised over 500K, if you've got over 20,000 a month in revenue, you want to make sure that you're getting to that level where you're putting some professional infrastructure in place, where you're putting some infrastructure in place that knows what they're doing and can really assist you. Do you guys have any questions? Is this the kind of information that you're looking for? Is this? And there's 5 of you. So if there's shit that you want me to cover that we're not talking about, we can talk about anything. One of the nice things that's going on right now is, we were talking about we're living in the future, but it's really impacted the accounting world in terms of cloud-based services. So there's different accounting platforms that have really good cloud-based services. A lot of our clients use Intuit QuickBooks just because it's very cheap and it's strong enough for our early stage clients. And that's a cloud-based service. Intuit, for us, it's $55 a license per month, which is, as far as accounting systems go, is pretty cheap. Another system that a lot of our clients use and that we see often is Xero. And Xero is a New Zealand company. And New Zealand really forced Intuit and some of the other players to go online and to really create cloud solutions. Xero, when they initially came out, they were really missing some very key modules and there were some problems. They didn't have one of the 3 major financial statements. Do you guys know what the 3 major financial statements are? So in the US, when people look at financial reporting, there's 3 primary financial reports that they look at. One is called a balance sheet. And a balance sheet is just where you are at any given time. It has your assets, and an asset is going to be your equipment, any cash you have, any accounts receivables you have. If you were looking at an individual, your assets would be your house and your car and the money in your different accounts. And it also has your liabilities. That's the stuff that you owe. So your accounts payable, your notes payable, any loans outstanding you have, any deferred revenue you have. So revenue where you received a payment for it, but you haven't done the service. If you were talking about an individual, your liabilities would be your car loan, your house loan, your college debt, your kids' educational fees that you owe, all those types of things. And then the last piece of the balance sheet is your equity. That's just what's left over, your net worth. So that's a balance sheet, and it's a specific point in time. So it's a glance at, so it's December 31st, 2015, here are my assets and my liabilities and my equity. The second statement is your income statement, and that has the revenue, your cost of sales or cost of goods sold, what the direct costs tied to that revenue are, and then your operating expenses, which are things like salaries and R&D costs. The profit and loss statement goes over a period of time, and you can choose the period of time. So it could be a day, it could be a week. Oftentimes we see it on a monthly basis. So companies report their profit and loss statement on a monthly basis and then do something more formal on an annual basis, on a yearly basis.
The profit and loss statement is the third?
This is the second one.
Oh, okay, it's the same as the income statement.
Yeah, so I'm sorry. I'm using the name synonymously. So sometimes called an income statement, sometimes called a profit and loss statement. I'm sorry. And then the third is a statement of changes in cash flows. And in the same way that the profit and loss or the income statement is over a period of time, the statement of changes in cash flows is over a period of time also. Because profit and cash don't necessarily go in line. So Zero did, for the first couple of years, Zero was out. They had a profit and loss statement and a balance sheet, but not a statement of changes in cash flows. Now they've come out with a statement of changes in cash flows. And so I think Zero is a good product also. So there's different online options. What we see most commonly used is Intuit QuickBooks. Do you guys understand why your cash and your profit might not be the same? Do you guys understand? There's a concept called accrual accounting, and generally accepted accounting principles use accrual accounting. And what accrual accounting says is that you need to recognize revenue when it's earned, not when it's received. And you need to recognize expenses when they're incurred, not when they're paid. An example would be a software as a service company. If you sold a 1-year software subscription and you received $600 for that 1-year software subscription, and they paid you the $600 up front, you would not recognize that $600 as revenue when you received the money. You would recognize $50 every month as you earned the revenue. In the same way, if you had insurance, and it was a 1-year insurance period, and you paid $1,200 for an insurance policy, but you paid it up front, you would recognize $100 in expense every month, as opposed to recognizing the entire expense up front. So revenue when it's earned, expenses when they're incurred. Does that make sense?
Yeah, it makes sense. In Spain it's the same.
Yeah, okay.
But here, with our accountant, it seems that he only takes our bank account movements when he's making all the forms for the year tax.
Yep.
So he never asks me for invoices or anything. If he sees some revenue in the bank, he considers that that's the revenue.
So he's using a cash basis.
Yeah.
So you are allowed to use a cash basis if you have under $5 million in revenue. But if you are planning on growing beyond 5 million, or if you're planning on getting venture capital investments and raising money, you will need to make the switch to accrual accounting. We like to start on accrual accounting, just once again with, you have a good foundation, you can build on it. But you should just be aware that right now you have cash accounting, which is not necessarily a complete proper reflection of the movement of money. And that if you go out for venture capital, you're going to need to make that change. And if you grow your business above 5 million, you'll need to make that change as well.
Okay, but you can change in the future.
Yes, you can change in the future.
How bad is it to pay cash?
How bad is it to pay cash?
If you have a receipt, can you?
Yeah, I mean, we hardly ever see cash transactions happening. I would say that if you actually pay cash, it's even more important that you keep receipts.
Mhm.
So for your cash transactions, even if they're under that $75 threshold, I would always just keep records.
What about more than 75?
Yeah, definitely more than 75. You have to.
But if you keep the receipt and then you just have that, and then you just,
You've done nothing wrong. Yeah,
nothing wrong.
absolutely nothing wrong.
And so if the IRS audits you and they say, where did this,
Where'd this cash go?
or this,
Yeah.
or if they say, if I say I paid in cash for this service, and they say, well, where is that? Where'd the money come out of your bank account? And I say, well, I took it out to this ATM here.
Yep.
I shown that.
So they won't ask you where the money comes out. What they'll ask for is just a receipt.
Okay.
It's just a receipt. Yeah. But cash is cash, right? I mean, it's still currency, right? I mean, you don't need to use a card. You don't need to make a check. You can certainly pay in cash. Cash gets a little scarier as you get larger as a company, just because it opens up avenues for fraud, and it's much harder to control cash, and people can walk away with cash much easier, and people tend to be a little funkier around cash, and it doesn't necessarily scale as you're building your business, but you can certainly use it. There's nothing wrong with using it. So in the same way that there's sort of good accounting platforms out there, there's also really good systems for accounts payable. So a lot of our clients use Bill.com. Concur is another program that we see a lot out there for accounts payable, and there's several others. These are also cloud-based systems, and the way that it works is, let's say you get emailed an invoice, and an invoice comes into you. It would come into Bill.com, and you would code Bill.com. Depending on who the vendor is, you can decide who on your team would receive that invoice. And then they would receive that invoice, and they'd say, okay to pay. Bill.com would know it was okay to pay. And then you set up rules. So you could say, okay, we want to pay our invoices, we want to pay everything 30 days after we receive it. Or we want to pay everything 10 days after we receive it. Or we want to pay all of our invoices on the 1st and 15th of the month. And Bill.com allows you to establish that, and Concur and all these other systems. And it also allows you to put in rules in terms of authorization levels. So, I like James. James is spending a lot of money. As long as it's under $500 an invoice, he can sign off on it. But if he's paying for something more than $500, I want to make sure I see everything that's over $500, and I also sign off on it. And you can put those rules in very easily. Very easy to set up those rules. And they're great because then it gets you out of the practice of actually having to write the check and manually sign everything. And it also gives you a really great audit trail, because every invoice that's come through Bill.com is going to be there forever, and it's stored in the cloud. So it takes, it helps with this whole idea of storing backup for all the material, because Bill.com has it all. And most of the systems will sync with your accounting platform. So Bill.com and Concur, I know both Bill.com and Concur sync with Intuit and with Xero. And I would assume most of the other big ones out there do as well. Those are the two that I have the most.
Is Expensify the same thing?
So yeah, Expensify is the next thing I'm going to talk about. So Expensify is exactly like Bill.com, but Expensify was originally created for employee expense reports. So if you have a larger team and you have an employee that's spending money, you want to make sure that they use an expense report form so that you can make sure that you have a good record of what they spent that money on. So you're not just, hey, I spent $1,200 and you're giving them $1,200. Hey, I spent $1,200 and I spent $500 on a flight down to LA, and I spent, $500 on 2 nights staying at a hotel on the boardwalk, and I spent $200 drinking. And it puts you record it on there, and Expensify works the exact same way as like a Bill.com. So you can say, this person needs to sign off on this person's expense report. And if an expense report is above X amount, then it needs to go to a higher level of authorization. Abacus is another expense reporting form that I really like. Abacus allows you to just take a picture with your phone of the expense, and you don't have to do an expense report, and it's immediate. So each expense you have, you're just sending off. So you're not pulling together the big expense reporting form.
What is that called?
Abacus, ABA. It's out of New York. It's a YC company. It's a Y Combinator company. Do you guys all know Y Combinator? A large incubator in town. Probably the #1 incubator. So probably Y Combinator followed by Techstars are probably the 2 biggest incubators in the country. So accounts receivable. We talked about taxes. Okay. Accounts receivable, when you get to a point where you're starting to have revenue, or you're starting to think about revenue, make sure you really think about what's the methodology for collecting from customers. How are you going to set that up? And think it through. Is it a point of sale system that you need to put in place? And if you are putting in a point of sale system, what kind of point of sale system would you like to use? We see a lot of people use Stripe initially when they first start out, but Stripe is really expensive. Most of the banks have point of sale systems. There's a lot of good point of sale systems out there. But think through that. If you're actually going to be sending an invoice out, think about what are your collection terms. Do you want to have net 10? Do you want to have net 20, net 30, in terms of how long they have to pay? Think about if you don't get paid, what are you going to put in place for collections? What type of infrastructure are you going to put in place for collections? I tell a lot of our clients when they're first starting to get revenue, especially if they're selling into Fortune 500 companies or larger entities, to try to get some deposits up front. Most of our clients are cash poor, right? And oftentimes it takes longer to collect from a Fortune 500 company than other kinds of companies. Sometimes it'll take up to 45 days to 60 days for a Fortune 500 company. Now, the nice thing about selling into Fortune 500 companies is that you always get paid. But it does take longer. So think through, and when you're thinking about your contract and when you're thinking about your sale and your revenue, also think about, how am I going to collect this money? How am I going to make sure I get it in my hand? Does that make sense? Okay. We talked a little bit about taxes. The one thing we can talk a little bit about is entity. You guys are set up as a Delaware C Corp?
Yeah.
Okay, and you're trying to figure out if you're going to be a nonprofit or a C Corp, and that probably depends on funding and things like that.
We're a California S Corp.
You're a California S Corp, and which is great. It's a nice way to start out. We don't see a lot of S Corps. We tend to see more LLCs than S Corps nowadays. There's some reasons that people want to be a C Corp versus an S Corp. And the reasons that we talk about are, if you're going to go outside and raise outside investment dollars, you need to be a C Corp. So venture capitalists and even most angels will only invest into a C Corp. And that's because it's much easier to deal with ownership equity in a C Corp. If you are planning on giving stock options to your employees, you want to be set up as a C Corp. It's much easier to give stock. Do you guys know what stock options are? Do people? Okay.
I'm not entirely clear on the concept.
Okay. But we understand stock options, typically what we're seeing in the venture world or the technology world is 4-year vests with a 1-year cliff, and then it goes out after that. Do you guys understand that concept? Okay. The thing about stock options that we should talk about is if you are giving stock options to your employees, you have to have a 409A done. Have you guys heard of that concept before? 409A. So back in like 2001, 2002, when did Enron fail? Like 2001, 2002? We had a large energy company in Texas that was doing all sorts of financial irregularities. And they failed. And after the Enron fail, our Congress, our government, came up with a set of laws called Sarbanes-Oxley. And one of the components of Sarbanes-Oxley said that if you give employees stock options in a privately funded company, you need to have a independent evaluation done on what those stock options are worth. And that independent valuation needs to happen either every 12 months or every time you have a significant event. And in our world, a significant event typically is another round of funding, whichever one comes first. Most of our clients get it done every 12 months unless they get a funding done sometime in the middle, and then they get another one done. So, stock options. We do valuations. Our valuation price starts at about $3,000, $3,500. So it's a total pain in the ass. It's a check the box. It costs you money, and it's kind of a bullshit exercise because you typically will know generally what your stock options will be worth before you need to do it. So it is something you need to be a little sensitive on price because you're not really paying for anything. You're paying for someone to do the work.
So I'm not really clear on the difference between stock options and equity.
Okay, yeah. So stock options are a part of equity. They're a part of equity. They're equity that you're basically giving to your employees that they're earning over time. And it's just a way of giving equity compensation to your employees. In fact, the corresponding entry on your profit and loss statement is equity compensation. So it is a type of equity. It's for employees and it's given over a period of time. And if an employee leaves your company, they either have to buy that equity or they leave it on the table. So.
What other forms of equity are there?
So the biggest form that you all will hear about in the venture world, and this is maybe not as relevant for you, but is common stock or preferred stock. And venture capitalists and angel investors get preferred stock typically. And that's, so say common stock is just you own a percentage of the company, right? One share equals X percentage of the company. You have a share of common stock, you own a piece of the company. Preferred stock, you own that same piece of the company, but you have preferences. You have special rights that other people don't have. And typically for venture capitalists, they get paid out first, right? So they either have a 1X, a 2X, or a 3X preference, which means that, let's say a venture capitalist puts $30 million into a company, and the company sells for $40 million. The first $30 million goes back to the investor. regardless of what percentage of the company they own. So they get their money back first before anyone else gets paid. That's typically the biggest preference. And every venture capitalist asks for at least a 1x. If we go into a downturn, that 1x will become a 2x or a 3x, which means that if they put 30 million in, they get paid 60 million first for a 2x, or 90 million for a 3x. But so that, there's some other preferences, like anti-dilution, we can't get diluted, or ratchets. The biggest thing is who gets paid first. But so that's called preferred stock and common stock. The options, options are common stock. When you give employee options, you're giving them common stock. Yeah?
So if a investor puts $30 million in and it's 2x,
Uh-huh.
and I sell the company for 60 million,
You get nothing.
you get nothing. Really?
Yeah, zero. Yeah. Yeah,
Who
absolutely.
who does that?
Well, anyone that raises venture capital.
And they sign up for a 2, 3x?
Well, so it's typically 1x right now, but in a down market, so back in 2008, I was a CFO and a COO for a French company, and we needed 20 million, and I did a 3x. We had no choice. So, yeah, that's why it's a huge difference. It's a huge difference.
When you say 3x, then isn't that like getting triple the equity?
That's one way to think about it. I mean, it's a pretty strong term, right? I mean, it's got pretty strong ramifications. Venture deals that we're seeing right now, unless it's a significant down round to people, if your company is valued for more than it was, if you go out and you raise a Series A round of funding, and then 12 months later you raise a Series B, if the Series B is higher than a Series A, it's called an up round. If the Series B was lower than the Series A, it's called a down round. We're going to start seeing a bunch of down rounds this year. A lot of components of a down round is preferences. So that's where you start seeing, because they've got power. They've got power and they use it.
So if
Quite aggressively.
If I'm investing in a there's a company worth, that used to be worth 20 million,
Uh-huh.
and now it's raising money at $10 million, then I could say, well, I want 1x.
Everyone gets 1x, but you could say you want 2x.
I want 2x.
Yeah.
So what happens if I say I want 2x?
Because if they're in a down round, it means that less people are interested, right? I mean, it means that their interest has gone down. So the investors have power, and investors use that power
So if I want
aggressively.
If I want so how do you determine if there's multiple 1x's, who gets it first?
They all get it at the same time. Depends on how much money they put in.
All right, but somebody puts in 20 million, another person put in 20 million, and both of them are 1x, and it sells for 30 million, then
Yeah, so you would look, those guys are each 20 million, so they're equal. So that's an easy situation, so they would each get 15.
Gotcha.
Yeah.
So it's proportional.
It's proportional. Yeah, it's proportion of how much money you put in and your preference.
But there's no priority, like one gets
No.
no.
So for any company, can an S corp offer any form of equity, or is that?
Yeah, so an S corp can offer equity, but it's a lot more complicated, and it tends to be more of granting of ownerships, and the legal sort of ramification around it is more complicated. So the legal contracts that you need to draw up are more complicated. The other thing to think about, if you're one entity and you want to switch entities, it's best to do it, if possible, with a new year, because you don't want to have a stub period. What a stub period, so let's say you're an S corp and you decide in June to change to a C corp, you're going to have to do tax reporting for California and the federal government for the first 6 months of the year as an S corp, and then for the second 6 months of the year you have to do as a C corp. So you have to double the amount of tax work that you have to perform and that you have to pay for. So if you can try and do it with your fiscal year, It's easier.
Okay.
But sometimes you don't have that choice. I mean, if you want to go out and raise money, you probably need to switch to a C Corp, right? So. Okay. Is anyone in this room planning on raising money? You guys are? Okay. So there's very standard expectations for what you have prepared when you go out and raise money. And I do a talk on fundraising, which I think is the talk I did. Did I do a talk on fundraising the last time I was here? Was that what we were talking about?
Well, I wasn't here for the thing. I think I just met you afterwards.
Okay.
Were you in there,
I think I was in here. I think I was in this room.
or did you go in there?
I went in there afterwards.
Yeah, I spoke to you. I mean, you were with another person.
Yep.
The woman.
Yep, Brienne, yep. So we do another presentation on how to raise money, but there's set expectations on what you need to have prepared when you go out and raise money. There's a couple books I really like on how you should prepare information. One is by Guy Kawasaki. And Guy Kawasaki, he was the first public spokesperson for Apple Computer. And he started GarageVentures.com in the late 90s. He's kind of, you know who he is? He's kind of, he's a rock star in the tech world. I mean, he's a nerd, but we're all nerds. But he's he's a rock star in the tech world. And he's a really dynamic, fun speaker. And he's written a book called The Art of Start. And it's all about what you need to have ready to go out and raise money. And you can actually YouTube it too if you just want to watch him. But it's The Art of Start. And he talks about what you need to have ready. Another book that does the exact same thing is by a gentleman named Mark Phillips. And I should be just completely honest, both Guy and Mark are good friends. So I'm pushing two of my friends' books. So Mark had sort of the Google of Australia and sold it for several $100 million and came over here, and he's now a venture capitalist. He runs a firm called Arafora Ventures. Mark's book is called The Inside Guide to the Silicon Valley, How the Deal Gets Done. And there's three things you need to have ready to raise money. One is just an elevator pitch, which is a paragraph. This is who we are, and this is what we do. One is an executive summary, and it's a one-page document, and it should have a certain look and feel. And then the third thing is the pitch deck. And a pitch deck is either 10 or 12 slides. I think one of them says it's 10, and one of them says it's 12 slides. But Mark actually goes through and he does a chapter on each slide that you need to have in the pitch deck. And Mark's done a bunch of webinars with us where he actually goes through and does a talk on preparing your pitch deck. And he talks about each slide and he gives examples. From a financial standpoint, there's 2 slides that you'll need to have ready to go out and raise that money. The first one is called your tops-down projection. And your tops-down projection, so the way that venture capital works, the investment thesis for venture capitalists is that for every 10 investments they make, they expect 5 to completely fail, just to be a complete wash. Maybe 2 or 3 will break even or they'll make a little bit of money. But what they're really betting on and what they really need to be a successful venture capitalist is for a couple to be a huge home run, to be really big. So that means every time a venture capitalist is investing in a business, they're not saying, is this a good business? Or is this a business that's going to make money? What they're saying is, does this have a potential to be a big home run? So what the top-down projection is your market size. Is this a big enough size so that they can have their home run? So that they can have the really big opportunity? Does that concept make sense? It's interesting. So we have a client over here over in the Embarcadero called Pacer Pro. And Pacer Pro has raised a shitload of venture capital dollars. And and they do a legal database. And they've raised like $25 million in venture capital dollars. And when I first sat down with them, I was really surprised that they had raised so much venture capital, because it didn't seem like that big of an opportunity. It didn't seem that exciting. Well, it turns out the legal database market is a $14 billion market, and there's 2 players in it, and they're both really, really old school, right? And so there's a real opportunity. There's a big market opportunity. That's what the tops down slide does. The bottoms up slide is a 3-year forecast that you need to have that will show where you think your company is going from a revenue and expense perspective. So those are the 2 slides that you need to have. Those books, both 2 3-hour books. If you don't want to read the books, look at Guy Kawasaki on YouTube and go onto our site and download Mark's thing on going through the pitch deck. Good preparation just to get you ready. VCs, Venture's been around for 30 years, 30 plus years. And they are very accustomed to seeing what they want to see in the order and with the types of slides that they want to see. Don't veer too farly outside, because it will make you look like you don't necessarily understand how this process is supposed to work, or you don't have the certain level of professionalism.
Excuse me.
Yeah.
Can you repeat the name of the first book you say? Not the Mark Phillips one, the other one.
Guy Kawasaki, and it's Kawasaki like the motorcycle,
Guy Kawasaki.
and it's The Art of Start.
He's actually one of our program partners, and he'll be here in the spring.
He's awesome. He's really, really good. He's much more dynamic than me. Oh, and we talked about this. Okay, so we talked about what the different financial statements were, right? The thing that our baseline financial package for our clients is these 3 financial statements and a cash burn chart. And the cash burn chart is by far the most important thing. Does everyone understand what the term cash burn means? How quickly are you running out of money, right? So for our clients, this is always a graph. And the graph always looks like this. And it's how much money you have and the amount of time, but it's how quickly are you burning through your money. And so if let's say your burn is, you have a monthly cash burn. My monthly cash burn is $25,000. I'm spending $25,000 a month. And then how much burn do you have left is a period of time. So you have $150,000 in your bank account. You're burning $25,000 a month. That's going to last you for 6 months. Right. That's very, very important. Cash is definitely king. I think that's kind of it we have. Oh, we talked about valuations too. I jumped around a bit, I'm sorry. Cool. Do you guys, is this kind of what you need to know? Does this give you a little bit? Can I get another slice of pizza and sit down and I'll answer any questions you have? Can I do that? Is that cool?
Before you can you go back to the top-down, bottom-up slide?
Mhm.
Thanks.
So the big thing that's important with the bottom-up projection that I really, really care about, and it's really important, is a concept called milestone financing. And you know how we talked about having an up round or having a down round? Every time you raise money, you want to have an up round, right? So every time you want to make sure that you raise money at a higher valuation than the last time. So I think it's really, really important when you're thinking about how much money to raise, the first question you ask yourself is, what are the significant milestones that I need to achieve to ensure that my next round's going to be an up round, that my next round's going to be at a higher valuation? And then you want to basically so you say, here are my key milestones, and then you say, how much will it cost me to achieve those milestones? And then always give yourself a 20 to 25% fudge factor because shit always takes longer and always costs more. But that should be what really helps you determine how much you can raise. But so think about, what are the big milestones that, when I'm raising money, what are the big milestones I want to hit with that money so that the next time I go out to raise, I can raise at a higher valuation.